Hello and welcome once again to the Smart Money, Dumb Money Show. I'm your host, Keith Richards. As usual, I'm President and Chief Portfolio Manager at Value Trend Wealth Management, and I'm a technical analyst. In fact, I have been in the business since late 1989, but let's say 1990 is when I really got going, and I began studying technical analysis in the very early 1990s. So I'm kind of an old dog in the game. And I want to bring some of that old dog knowledge to you via this show. So I hope you do enjoy it. Today's a really short one because I really want to talk about one chart. I'm going to cover the US healthcare sector. Now, not specifically because I'm recommending it or I think there's anything special about it, but what I'm seeing on the healthcare chart is a pattern that I've seen before. And so let's treat today's video as more of an educational video rather than, hey, you should buy healthcare or any other sector or stock. I'm using this as an example so you'll understand how things happen sometimes on the markets and specifically after a long sideways base breaks out. So let's get right to it. I'm going to share screen and I'm just going to bring you to stock charts directly and one chart. That's all we're going to be looking at. So this is the XLV, the Healthcare SPDR ETF. And as you can see, it was going sideways for a pretty long period of time, really from the middle of 21. So there's 2021 on closer to the left-hand side of the screen. There's the middle. So it was kind of trapped, if you want to give it a number, probably around 135 bucks or so. And it stayed there with lots of ups and downs. Great trading opportunity, by the way, for people willing to move in and out of that ETF. But after it ran sideways, literally from mid-21 right into the end of 23, in 2024, this year, early in the year, XLV, the healthcare sector, broke out. And this is interesting because there's an old saying within technical analysis, and that saying goes, the greater the space, meaning the greater the long-term sideways period, the greater the case. So in this case, the breakout should mean that there is a ton of upside on XLV. And I am absolutely not here to tell you that there isn't or there is. But I do want to suggest that one factor on this chart is telling us that it may at least take a pause. So let's just examine a basic principle of technical analysis, and that is that sometimes after a breakout, a stock can get overbought and then it will correct. And the extent of the correction, if it's a healthy correction, is only back to the old breakout point. Now, I haven't drawn any lines on this chart, but the old breakout point was around 137, 138 bucks. Let's call it $137. And so the stock right now is 143. It has pulled back a bit from its high of around 147. So the potential is a healthy possibility of this breakout to retest the neckline, and that's what we call it. The old resistance point on the long-term sideways period is called the neckline now, and it'll pull back possibly at or near the neckline. Now, this is not an absolute, it's just a potential, but I'd give it a greater than 50% potential, especially with what I'm going to show you now. So now what I want to show you is this indicator, which is the money flow index. Now, if you know anything about money flow, it's really just the advancing days versus the declining days, or on a weekly chart, in this case, advancing weeks versus declining weeks, and then applying the volume to that, and you start to get a picture of the not just the money flow, but the momentum of that, because it's a advance, decline, the volume, and it's more importantly got an RSI like formula applied to money flow. So instead of it just being a direct line, like the advanced decline line, it's kind of an ever moving line. This indicator is money flow, like an AD line, but with an oscillator applied to it, very much like we do with price, with straight RSI, which is applied to price. So this indicator actually is pretty good at picking peaks and troughs. And you can see that here, this lined up with a trough there. Here, it lined up with a peak there. So it's not an absolute, you don't use it as your exclusive way of going in and out of the market. As you can see, lots of times it didn't exactly pick those peaks and troughs, but sometimes the very, very strong moves are picked. And in this case, you can see that this stock went up, or this ETF, I should say, went up quite a bit on a lot of volume, and it did get quite overbought on this RSI-like indicator. So what we have here is around February, we saw an overbought signal on the money flow index, and that kind of lined up with this peak here. So the next thing we saw was a rounding over of the MACD, and very, very recently, today is April the 9th. I have to look on my watch all the time to know what day it is. April the 9th. Well, April the 9th, we are just seeing what's called a MACD crossover. But we had early warnings as it was rounding over. And you might remember on some of my other videos, I've talked about the MACD bars and the histogram. And the histogram shows us that it was declining and giving us a little bit of warning that things were not only overbought, but beginning to maybe round over. Finally, we will go to the RSI on price. So RSI is a pretty good momentum indicator that can pick periods of peaks and troughs. And there we go. We went into an overbought signal, and it's done this before. In fact, you see a MACD crossover, an overbought signal there, and an overbought money flow, and sure enough, it ended the uptrend and resulted in a small pullback. All right, so you'll get these signals. That was the same signal here, overbought money flow index, a MACD overbought and crossover, and the same thing with RSI, and you got a pullback. So I think that if we go back to the top of this chart, that this breakout is probably legitimate. I don't think we're going to go into, a 2020 COVID type crash, because that was an unusual situation to begin with. But I do think that we had an overbought market that is indicated on those indicators we just looked at, that has a decent chance of returning, or at least getting close to the old breakout point, which lies somewhere around as I said, about 137 or so. I like using round numbers. I like picking approximate points. So if this indicator that we've just looked at, some of the indicators suggesting there's a potential for pullback, we might see another $5 pullback, which is not a disaster. But what it does tell us, if it finds support at or near 137 or anywhere around there, and then starts to move up again, that was a successful test, and that the bull market is definitely, well, nothing is definite, but let's call it, is highly likely to continue for the healthcare sector. So I would use that, should we see a successful test of somewhere near $137, I would use that as an opportunity to maybe add to positions or add a new position, keeping in mind that if it ever does break that neckline of around 137 to the downside, that's your stop out point. So you would sell it maybe $2 or $3 below 137 if it failed. So it's a pretty cut and dry trade. Let's see if it pulls back. All the indicators are suggesting it will. Let's see how close it gets to 137. Let's see if 137 holds. And then let's maybe consider taking a position if it does hold, with the idea that if it fails and it goes below 137, we're going to cut our losses pretty close and pretty short. We're not going to stay in the trade. But if it does hold 137, we might expect great things to come, because again, that long-term sideways period that you see on the chart that started late to mid 2021 indicates that there's tons of upside after a super long consolidation period. So I hope that this, I will stop sharing now and go back to my mug shot. And I do hope that this little lesson in this ETF chart that we're looking at is applicable to other securities that you look at, because we do get these occasional amazing looking breakouts after long periods of basing or consolidation. And those breakouts are 8 out of 10 times pretty good, like very, very bullish. Sometimes they get a bit overbought and they can pull back. And so long as the neckline isn't broken from that original breakout, it could be an excellent buying opportunity. And again, a very logical plan of attack, because if it breaks down below where you just bought, it's probably a failed breakout. But we're going to assume that this breakout is real based on the length of it. And we're going to assume it may pull back a little bit, maybe to 137. And we're going to hope that it can hold to 137. So maybe we have an opportunity to take one leg into the position. And if you've taken my technical analysis course, you'll know how I work in legs. I don't just buy my full position. If I wanted, say, 6% in this particular sector, if it does do everything we just talked about, pulling back to the 137 and successfully staying there or above it, I might take 2%. And then I might go another couple of weeks and buy another 2%, etc. Or maybe just 1 week and buy another 2%. Whatever the case, you do things in stages, you do things logically, you do things with discipline, and you follow your rules. I hope that helps. And that hopefully is an educational piece on understanding breakouts and one more way to trade them. You have a good day, and I will see you in a week.